All right, we are live. Make sure my microphone's working. Okay, we are live, living large. Let me post this real quick. Still learning how all this stuff works, you know? Sometimes it takes a second, you know? Sometimes it just takes a second. Okay, let's get this over here. All right, welcome. My name is Ryan, and I am a mortgage nerd. And I love talking about mortgages. I've been doing the mortgages since 1999, so I've helped a lot of people with refinances, with purchases, with all kinds of different ways to get real estate financed. And I just love jumping on and answering a couple questions once in a while. It just helps add content to the channel, keeps me on my toes a little bit. This is all live, so if you do have a comment, throw it in the chat. I'll try to get to those as we go along. But I do have some questions that have popped up over the last little bit that I thought were pretty interesting and worth discussing. And then we'll jump on Quora and a couple other places to be able to find some more questions. But if you have any questions, please jump on. Again, my name is Ryan with Patriot Home Mortgage. I am licensed in Utah and Nevada. If you need help in other states, I can refer you to somebody else. We have a lot of people on our team here at Patriot that are licensed around the country, and I just have relationships with other states. Starting to get more licensing activity in other states, so I might get some more licenses. But for now, I just have a license in Utah and Nevada. So let's just jump into some questions, see how many we can get answered here. And again, if you have any questions, go ahead and jump onto the chat and we'll answer those questions for you. So here's one I thought was kind of interesting. Why do banks offer lower interest rates on home equity loans compared to credit cards? The biggest reason is the collateral. With a home loan, they actually can take something back if you don't make the payment. And even though the interest rate's higher on a home equity line of credit than, say, a first mortgage or a purchase loan, there's still more collateral. With a credit card, it's basically your name, you're signing your name to it, and that's basically it. And you can use that credit card to buy almost anything that accepts a credit card. So there's just less ways they can recoup their investment, less ways to get their money back, because it's not tied to something that can just disappear. A home is going to be in that location. Now it can burn down, it can have issues, but usually insurance to cover that type of thing. So it's just different collateral. So the more collateral lowers the risk, which then means rates and terms are lower because it just lowers the risk. So I think that's probably the best answer to that question. Let's jump into a couple other categories here real quick. Let's go into credit, see if they've got that. So I think credit's always one that everybody has a lot of misnomers when it comes to how credit works. First question here is, what are the best ways to build up my credit score? It's one of those funny things. You have to have credit to get credit, right? Especially when you're first starting out, you're like, well, how do I get credit if I can't get credit? So there's a couple things you can do that are available. Experian and some of these other companies do have what's called Boost, where you can report other payments that you're making. And the most common one is like to your cell phone bill. It's amazing how often people have a cell phone bill before they have any other utility bill. But any utility bills can be reported, anything that shows a history of you making a payment. Another great way to be able to build your credit is with a secured Visa. This is where you give them the money, say $500, and they give you a $500 Visa. The downside with that is you're basically giving them the money that they're charging you an interest rate for. But a lot of times, because it's secured against that money, it'll get you started with a credit card. The other trick with the credit card is you don't want to borrow more than 30% of your limit. So if you do go get a $500 credit card, you want to put something on the card, maybe $50, fill up the car, maybe $100, that kind of thing. But you don't want to go over 30% of your limit. A lot of people will max off a credit card, pay it off, max it off, pay it off, or something along those lines. The problem is the credit bureaus typically only see that account once a month. So whatever's on your statement is what they report to the credit bureaus. So you can pay it off that very day you get your statement, but they've already reported your balance. Then they wait 30 days and report it again. So if it's slowly gone back up to maxed out or higher on its limit, they never really see that it's actually paid down. Now, there is some cards that do report more often. There is trending data of how often it gets used. But the safe thing to do is not go up to the max, is to go under 30% of the actual limit, but not down to zero. I've seen times where it's completely zero, doesn't get factored into the algorithm as much as if there's even a $30 balance on the card. So that's one of the tricks. is you want to keep all of your limits on all the revolving accounts under 30% of the limit. That's where you're going to see the biggest boost to your score, not maxing off, paying off, maxing off, paying off. That doesn't help as much as keeping the balance under that limit. So maybe that'll be helpful even if you have credit, but that's one of the best ways to start building credit is some sort of revolving account. It can be a gas card. It can be a overdraft account with your checking and savings. It can be anything where you can use it, pay it off, use it, pay it off. That's what the revolving feature does. And that can factor in your credit score better than almost anything else other than just time, making your payments on time, things like that. So if you're just starting out, you can look at Experian Boost as one of them. You can start reporting some of your utilities or try to get some sort of small credit card. I mean, a lot of the gas companies will offer a limited credit card to get you started as much as anything else. Now, the rates and terms aren't going to be as good until you build that credit, but that's one of the great places to start is with some sort of revolving account. Here's a question. Can hackers change credit scores? Maybe. I mean, if you hack the system with the data that's on there and change that data, the problem is it updates every month. So even if you hack it for one credit cycle, you could hack it at the first of the month and not everything's reported yet. You could hack in the middle of the month and some things have and some things haven't. So the credit report's kind of dynamic in a sense. Now, it usually is once a month that there's some sort of updating, but that once a month for, say, Chase might be different than Wells Fargo from when the credit card or the mortgage was opened. So the dating of it can be very different. I see a lot of reporting that usually happens kind of middle of the month when the statements go out. That's where you see most of the updates, but some update on the first of every month, some update at the last of every month. So even if you could hack it, you'd have to kind of time that to when anything was updated, because as soon as something else hits, it's going to, that hack, if you will, would just go away pretty quickly. But could they hack credit scores? I guess, yeah, they could change the data that the credit bureau is using, but it'd be really, really tough. But I guess the answer is maybe, but it wouldn't last very long. Even if you could do it, it wouldn't last very long. Let's see what else we got here. What's the best way to use a credit card? Well, sparingly, because the interest rates are a lot worse. Use it to get the bonus, the miles, all those types of things, but try to make sure that you're paying it off or paying it very close to zero within the cycles. The problem with most credit cards is it gives you access to more money than you can usually pay off within a cycle. So you want to be disciplined on what you're using and not just use it as a free-for-all. I saw a scientific study that said how much harder it is for people to pull cash out of their wallets to pay for something versus using a credit card. There's like this psychological removal of actually having to use your own money or use your checking account, which the credit card companies know, and they use that to their benefit as well to be able to make sure that they're getting you to use the card and going into massive debt. I mean, the interest rates on these things is not that great, but they can be a vehicle you can use as long as you can use it sparingly, or make sure that when you do use your credit card, you actually have the money in your account. You can pay the credit card right back off, right back down. I know a lot of people that have used the heck out of credit cards and paid very little interest rates, gotten the bonuses, the mileage, the free Sky miles, all that stuff by using their credit card, but they always make sure that, okay, they'll even open up their app as they're sitting there ordering food or whatever and pay it, right there or very soon after they do the charge. So it's a discipline thing. You can use credit cards to your benefit. There's a big benefit to your credit score as long as you keep it under 30% of the limit. So that's where I would say credit cards can be a good financial tool, but they can also be a trap. And a lot of people, unfortunately, are stuck in that trap. I think there's trillions out there in credit card debt, and a lot of it at 20+ interest rate. There's a lot of money made on these credit cards as well. But so it's just a discipline factor. Don't overextend. Don't use it without having the money to back it up. That's I think the best advice on credit cards. Let's do maybe credit scores. Let's see if there's anything about credit scores. Maybe let's kind of dive into credit for a second. See if there's any questions. If you have any questions, you can add them to the chat. Can I increase my credit score? Absolutely. It's with time history and paying on time, getting rid of collections, charge-offs, kind of dealing with some of the bad credits is definitely a good place to start. But credit cards are a really good way to help build the scores we've been talking about. What's the best way to increase someone's credit score fast? It is a history still. So there is things you can do to be able to boost your credit score by getting things cleaned up. But a lot of it is a history. And if you did 12 years of bad credit, it's not going to clean up as quick as people want, because they finally decide, okay, I'm going to take my head out of the sand. I'm going to deal with this. I'm going to go deal with my creditors. I'm going to deal with all this kind of stuff. It is going to take some time. The fastest thing that you can do is start adding some positive, or get your credit cards under control, get them under 30% of the limit, kind of manage that money a little bit better, cut them up if you can. If it's somewhere they're just misused, lower their limits or get rid of them as much as you can. But credit cards can be one of the fastest ways to start rebuilding a credit file. But I've had so many people that are years and years of bad credit, then they decide they want to buy a house, and they say, okay, I want to buy a house, my lease is expiring, or it's just time to buy a house, want to buy a house, whatever it is. Now they start to want to fix years of credit issues, and it does take time. So I would say, have me do a review. I can do a free review for you. We can take a look at your credit scores. I can give you a list of what to do to start building that credit profile, so that way you are ready to take advantage of a home loan when the time comes. But too many people bury their head in the sand. They did some mistakes when they were young. They got overextended. They turned in a cell phone, and the contract hadn't expired. Or I see it with internet. You're supposed to turn in like the modem and you don't, or the DVR dish thing and you didn't, and it shows up on credit, or there's lates on student loans. I mean, I see it all dealing with credit, but it is something where the sooner you can kind of start dealing with the negative while adding some positive, the sooner you will be better. And I tell you, credit ties into mortgages like crazy, but it ties into everything. I mean, it's morphed into employment. It's morphed into car loans and mortgage loans and visas, and so many things tied to your credit. So improving it will only help your financial situation, because other debt you'll get will be better interest rates as well. So it's just important to keep an eye on that little 3-digit number and just start working on it and start fixing it where you can. Let's see, what is considered a good credit score? So 680 is pretty much the good credit score tier, anything over a 680 credit score. When you start getting into 720 plus, you start getting into kind of the A category. If you're under 680, you start getting into kind of more of the B type category. Mortgage loans can go clear down to like a 580 credit score, but rates, terms, down payment always change. So for a lot of our programs, 620 is a good tier, 660 is kind of the next one, 680, they're all kind of tiered, and each tier can open up cheaper mortgage insurance, cheaper interest rates, different guidelines. Things can open up as you improve that credit score. And I've had a lot of clients who are in that 620 tier. Getting them to 640, 660 isn't too hard if we have some time to know kind of why the score is the way it is and work on things to be able to boost up that credit score. They usually go in 30-day cycles. So if you just miss the one, now you've got to wait 30 days for the next report, then 30 days after that. So we can get 60, 90 days. We can do a lot to help your credit score rebound. Now, to get in the 700s, that's going to take a lot more time, a lot more clean history, a lot more disputing or removing or paying collections, whatever it is that's keeping the credit score down. But I would say the average is right around a 680 credit score. So if you're under that, you're below average. Above that, you're above average. That's really the first target for people to get that 680 score. When you start getting into the 700s, that's when it starts getting great. Now, mortgage loans, I think the top tier is 740. There's a few that 760 kind of kicks in. So once you hit 760, you're kind of in that A plus category. You can be all the way up to 800, and it doesn't make a huge difference once you hit that top tier. But anything below there is in 20-point tiers. And so if you can get yourself into that next tier, better interest rates, mortgage insurance, other things kind of chip in that will make it worth the effort to get that score up. Now, does it prevent you from buying a house? Like I said, we can do 100% financing down to a 620 credit score. But if we get 660, if you need 100%, that's really the target we're going to try to do, because it just makes your interest rate better, which makes your buying power more, which gets you a little better house for the same monthly payment, all that type of stuff. So I hope that answers that question, but I would say 680. What affects my credit score? Well, there's really 5 major categories. You've got the history, the type of credit, you've got inquiries. There's a couple things that factor into the credit score, but there's a lot of things that don't affect your credit score. Like I recently had a real estate agent ask me if a DUI affects the credit score, and it doesn't affect the score unless there's some sort of judgment or restitution or collection or something involved with that DUI. But just the ticket, if you will, doesn't affect the credit score. Now, also a debt ratio. I have people that say, well, my debt ratio is really high, so it's affecting my credit score. Really, debt ratio doesn't, because they really don't factor in your income as part of a credit score. That's other guidelines. That's other ways to qualify for a mortgage loan or car loan or whatever it is. That's a different part of underwriting. But credit scores really don't factor in your income. they do factor in your balance to limit ratio. So they do look at, okay, how much credit do they have? Let's say they've got $5,000 worth of credit cards, $10,000 worth of credit cards. How much of that is drawn out? How much, if they have a $10,000 limit and they owe 10 grand, they're at 100% drawn out. So they'll factor that in more than they're going to factor in your income as part of the credit score. Let's see what else for the. How can I raise my score to 800? A lot of that's going to take time. It's going to take that balance to limit ratio. It's going to show paid history on time. It's going to have car loans that have been out for more than 6 months, more than 12 months, more than 3 years. There's tiers, closed accounts that are paid on time. That takes more time than anything because it's maximizing all the algorithm to get to an 800 score. So really it's going to take time and really good credit history, payment history, credit usage. That's when you're going to get those 800 scores. Let's see, what will help my credit score increase the most? By far the biggest category, it's balance to limit ratio. Your revolving accounts limit to what you owe is that balance to limit ratio. The more that's under 30% total, so you can have, let's say, a $5,000 credit card maxed off, a $5,000 credit card that's zero. Well, then you're at 50%. Does that make sense? Because you've drawn out 5,000, but you have access to 10. So if you take a look at all your revolving accounts, so overdrafts, credit cards, gas cards, anything that is a revolving feature, a credit card, if you add up all those together and then you add up all the limits and then you add up all the balances and you take a ratio from that, that determines that balance to limit ratio. That's one of the fastest ways to increase credit score is getting that under the 50% and then 30%. So getting those credit cards paid down. And again, I wouldn't leave them at zero. So you get them down to where they're all under, say, 50%, and then you get a few of them down even further, but you want a small balance on a couple of them so it makes sure it factors into the algorithm. I've seen times where they're all zero and doesn't actually help, where if they even have like a $30 balance on a $10,000 credit card, the score really seems to pop because it actually registers that balance as part of the balance limit ratio in that algorithm. So I've seen it's actually better to have a small balance on the credit card. Now, it doesn't need to be all of them, just again, a few of them to get that balance to ratio to really kick in. So it's one of the best ways to increase a credit score outside of dealing with some of the negative things that might be dragging the score down. But I have also seen times where people start to work on their credit and they go backwards because they'll start thinking, well, I need to pay off that collection that was 5 years ago or 3 years ago or 2 years ago, whatever it was, medical collection, whatever it might be. And what's funny is sometimes they haven't reported for so many years that by paying it, even though it is better to have it paid, it updates it to a new paid collection. It looks like it's newer based on the dates. So when I'm sitting there with a client, I'll say, okay, let's look at balance to ratio on the revolving accounts first. Next, let's look at the negative. What's reporting right now? What is the most current reporting negative account? That's the ones we want to target first, not the one that hasn't reported for 2 or 3 years, because it can artificially kind of update the date on it, which then can actually lower the scores. Now, you're hitting kind of a ceiling because of that collection account, so it's good to deal with it eventually. But if you only have a certain amount of money to work with, you don't want to plunk it all on the one that's not going to actually get your score up the quickest. You want to get it to the ones that are reporting the most recently because they're the ones actually updating the balance, updating the interest, the penalties, whatever it might be. So those are the ones you want to target first, are the ones reporting more recently. Way too many people make assumptions on fixing their credit, and almost every time they go backwards because they start trying to fix the wrong things. And so talking with me, talking with a lender, talk with a credit repair specialist, whatever it might be, let us kind of point you through how to get your score up as quickly as possible. So, but I've had so many people go backwards. Now, it's still good, but it just adds more time before they get the score that they need. That if they had the same amount of money to work with and would have paid off different credit cards or different collection accounts or charge-offs, whatever it might be, they'll see their score go up a little bit quicker, which keeps them motivated. So many times I see people start this credit restoration, get discouraged within 30, 60 days because their scores aren't really going up like they were supposed to. And so part of it is the education on doing this. So pulling a copy of the credit report, going through why it is the score that it is, what can be the ways to improve it, will get you more motivated, get you down the road, get you into home ownership, better insurance rates, better car rates. So many things are tied to credit. So working on it now and getting started is better than waiting 6 months from now or a year from now. Start early. There's so many things, and it's so much cheaper if you can start working on it now than having to do rescores or credit restoration services and these other things to try to speed up the time frame. If you have a little time to work on it, it'll also be cheaper. All right, let's jump into real estate. Let's jump back to mortgage, actually. Let's see what questions we can come up with. If anybody's in the chat, you can ask a question there as well. I'll have to answer any questions you have about real estate, credit, mortgage, any of that type of stuff. So let's jump into, let's go real estate. Let's see what's in the real estate section. How common is it for a seller to remove items they were supposed to stay with the house? Oh man, that does happen once in a while. So if it's not bolted down, there's assumption that it's there. So you have to specifically say if a couch or furniture, TVs, stuff like that. Now TVs are usually mounted as well, but there's usually a distinction to what's mounted. Even refrigerators sometimes aren't necessarily part of the house unless it's part of the listing. So you do want to make sure that if there is something specific to the house that isn't in the listing or is, that you do clarify in the contract what is supposed to stay and what is not. I've used this story before. It's probably one of the most crazy stories that I heard. I had a client that bought a house, closed on it, pulled up that day with the moving truck, and the previous owner had taken all the boulders, all the landscaping boulders that were in the front yard and took them when he sold the house. And they hadn't been to the house for a little while. They were waiting to, it was the craziest thing because the bulldozers and that tore up the front yard just destroyed that front yard to take those boulders out. And so when he pulled up, he had no idea the seller was gone. That was a pretty crazy story to see and the damage they did to pull out these boulders in the front yard. It wasn't even like they tried to do it carefully. I mean, they just ripped out almost the entire front yard to try to get these boulders that the guy wanted that he assumed wasn't really part of the house, even though it was on the real estate. So that gets a little scary. And they ended up coming to a resolution. They paid for. I don't think they brought the boulders back. I think they just paid to fix it or to restore the landscaping. But the most common thing you'll see is like refrigerators, mounted TVs, maybe some sort of a bookcase or something in the garage. You'll see these types of things. So you just want to make sure you talk with your agents, clarify what's included. A lot of times what's in the listing will be what they say, okay, everything that's in the listing that you've advertised is for sale. That's what we want included. And that's just part of negotiating on the house to make sure that it is what you want. But I saw a client that took the chandelier. They had this really nice chandelier. They took that and just left the wires hanging there. So it's not like they even replaced it with something cheaper or something like that. So that does happen. It definitely does happen. And that's where the agents have to get involved to be able to get that fixed and just make sure it was actually included as part of the offer. But most anything that's kind of bolted to the house is definitely included. So that's where it becomes a conversation you have to have with the agents that are involved. All right, let's see what we got. I want to make sure I click the right thing here. Okay, let's just go into general. Oh, can I transfer a title from my personal name to the name of my living trust if I have a mortgage on the house and it's not paid for in full? Yes. So you can move the property from your personal name into an LLC, into a living trust or will or that type of thing without an issue. Sometimes there are states that will do what's called a due on sale clause. So you just have to show that you are the owner of what you're transferring into, but it is very common to do that. Now, some states will have transfer taxes. So you can, I believe, in some states, you can move it into the trust or into the LLC. But if you try to move it back out, there's transfer taxes. So you want to be aware of any kind of property transfer taxes that you have. But the short answer is yes, you can have the mortgage in your name and then have the asset put into some sort of secured investment, as long as you're still the owner of that. So if you don't own the LLC or don't own the trust, that's when it can have that due on sale clause with the lender that if it does transfer. But it's very common for people to do those things and move things around with warranty deeds and that type of thing. Just has to make sure you're still an owner of whatever you're transferring it into. You can even add let's say you get married and you have a spouse that wasn't on the note, you can then add that person to the title as well without affecting the mortgage. So the mortgage is really securing that asset. So if you're moving that asset to another owner, you just have to be the owner of whatever it's moving into, like the owner of the trust, the owner of the LLC. So that's a good question. Let's see. How do you protect yourself legally when buying a house in a neighborhood without an HOA? How do you protect yourself legally when buying a house in a neighborhood without an HOA? There's got to be more to that question, because when you run into an HOA, you've got laws and covenants and restrictions on what you can do with the property when it's inside of an HOA. When it's outside, you really don't have those protections, but you also don't have that uniformity. You don't have that a committee or an architectural committee that says, okay, you can't park a car without tires. You can't park on the grass. You can't have a fence a certain height. I mean, there's obviously love-hate relationships with HOAs. There's some people that really like them because they maintain the community. They're kept a little bit nicer depending on the density of the community. So there is some rules and there is some amenities. Usually, maybe there's a tennis court, a basketball court, a pool, a common area. There's usually maybe a fountain or some sort of water feature. I mean, there's all kinds of stuff that HOAs have. So how do you protect yourself legally when buying a house? I don't know if you would need to, because I don't know, unless you're getting sued for something you're doing with your property. That's where homeowners insurance would kick in if somebody trips and falls and tries to sue you for breaking their leg on your property. But definitely would need more context on it. It looks like this was just posted a little while ago. I don't know. It depends on what somebody's coming after you legally for that is tied to your property. I would say would be the answer to that. What's it actually like trying to buy your first home in today's market? There's challenges, just like any market, whether it was 10 years ago, 20 years ago, 30 years ago. There's always going to be different markets. There's different challenges. The combination of the price of homes with the interest rates is making it a lot harder for first-time home buyers to enter the market in the first place. But as far as availability of loan programs, availability of down payment assistance programs, I've never seen so many ways to help people get into homes than we have right now. There's a huge opportunity for people to get in. 100% financing is available. There's so many ways to help people into a home that I haven't seen in my career. So I think it's easier for the financing part of it. It's harder to find the home. It's harder to find a home that fits the budget. So I'm seeing a lot more first-time home buyers are doing is teaming up with a family member, a sibling, a roommate from college on that first home. They're kind of teaming up to get the first one. Then they decide whether they're going to sell it after that. One of them may get married or moves or job changes, and they turn that property into a rental or sell it. But I'm seeing a lot more families having to co-sign or combine with friends, family, that type of stuff to get into the housing market, depending on where you're at. So there is any market's going to have its challenges, but I think there is actually a lot more going for first-time home buyers than I've seen in a long time. There's just a huge emphasis to help people into homes with the limited market that we do have. Let's continue in this section, see if there is, where can I find a co-signer? Boy, this is a topic that we just actually hit on it here just a second ago that I'm getting more questions about, because when you co-sign on a loan, you are obligated on that loan as equally as the person that's signing the loan. It's not like I'm just co-signing for them to use my credit or income or assets, but I'm really not tied to the loan. No, you are 100% owner of that property, just like whoever's co-signing. So if they miss a payment, it affects your credit. If they want to take your name off, they still have to qualify on their own. So if you are co-signing for someone, you want to know what the exit strategy is going to be. Is it going to be to sell the property? Like we here in Southern Utah, we have a lot of people that will buy a house as they go to college. So I have parents that will buy the property for their kids, and they'll get roommates and kind of share the expense of that house. So they have just a permanent place, have a house, build some equity while they're staying here. So they have to have an exit strategy. And usually the exit strategy is then selling the home, distributing the equity to whoever's the owners, that type of thing. But the idea is just, well, eventually I hope to qualify for the home. You may be stuck on that loan for longer. And if you're the co-signer and you're thinking about buying a house, or you got business expenses, or you got things coming up, that mortgage shows up on your credit as equally as it does for your son, daughter, cousin, family member, whoever it might be. So finding a co-signer is usually a family member. I don't see very often where you just get a random co-signer, unless it's maybe a business partner or see some roommates in college or that type of stuff will co-sign or that type of thing, but usually are also cohabiting the property. So usually staying on the property as well. So there's benefits and disadvantages with co-signing. And I don't say it's a hard no, but I don't think it's an easy yes. You've got to go through the benefits and disadvantages of co-signing for a family member, friend, whoever it might be, because the biggest thing is you're stuck on that loan until it can get refinanced. And you have a lot of people right now with low interest rates that don't want to give up their interest rate, but they got to get rid of a cosigner. The only way you get rid of that cosigner is a refinance. They don't just drop that person's name off the loan unless you can qualify on your own. Because if you're the lender and you loan to, husband or a dad and son, let's use the scenario. You got a dad and a son. Well, they're doing the loan because of the qualification of both. If you drop off the dad, can this son do it on his own? If he can't, why would they let the dad off the hook? That's why you got the loan in the first place. So it is something where it's important to know that you're not off that loan until it sells or refinance. And if you're not ready to be on it that long, then you want to reconsider the cosign situation. Now, if you're good with it and you know, okay, this is just a temporary thing anyway, we're going to sell the property in 3, 5, 7 years, whatever it is. I had a perfect example. I had a client that bought the house because he had 3 kids that were all going to go to college, and he basically bought the house so each one of them would have a house, roommates, have a place, build the investment, tax benefits, all the things that kick in with real estate, because he knew it was going to be like a 7-year window when the kids were going to be going to school. Made perfect sense. And it made really good financial sense as well to have that stability of a mortgage payment and the experience, the equity, all the things that kind of tie to that. So that really was a great scenario for that particular family. So there's ways to co-sign that really make a lot of sense. But to just find one, you got to start probably with family. Family is going to be your best option when it comes to trying to find a co-signer. Let's see, my townhome is all paid for. Should I borrow some money to buy another property? Depends on what the use of that other property is, but yes, you've got equity sitting there, you got tax benefits, you've got, depending on if you're going to sell the townhome or if you're going to keep it as a rental, but you've got money sitting there, you've got equity that's sitting there that is a better rate as a primary residence than it is if you go buy another property or turn that into a rental and then try to get a loan against it. So depends on what you're buying the other property for. If you're buying the next one for an investment property, absolutely. Your financing terms on the townhome you're living in will be better than buying a rental property with a down payment. So I would say, yes, you've got money sitting there. If you have an investment or have an opportunity to buy another piece of property, a cash flowing property, that you've got the money to do it. I would say that's a great way to do it, depending on if it cash flows. So there's a little bit of digging through to make that work. But when you've got the house free and clear and you want to buy another house for whatever reason, then you've got some equity there you can use for down payment or paying cash, or there's a lot of things you can free up depending on the rates and terms of the loan on the townhome. So I'd say yes. What is a safe way to improve my credit score while paying off debt? So this again is where you want to pay down the credit cards first. So let's say you've got 3 credit cards and they're all maxed out. Let's just use that analogy. A lot of times people will pay one all the way to 0 and leave the other 2 alone. What you're better to do is pay all 3 of them down under 50%, even 30% if you can, then start to tackle and pay them off all the way to 0. So that's the first thing with revolving accounts, because what will happen is if you got those 3 cards and you paid 1 to 0 and close it, now you're maxed out on the other 2, where you're better off to kind of get them down at the same time and then eliminate them. When it comes to other debts, it doesn't matter if you pay them off faster, like installment accounts, mortgages. If you accelerate those, that doesn't really factor into your score as much as revolving accounts. And I think most people are trying to get out of debt are looking at credit card, revolving, store cards. That seems to be the first target because the rates are usually worse. So I'd start with the credit cards, get them kind of all under 30%, then start to pay them off. So you're spreading out that money evenly so your scores can actually go up during this process instead of down, and then start tackling the other installment debts and things like that. Now, also what I recommend, I see a lot of people will take every penny they have to pay off debt while they're not building for savings, emergency, retirement. So I would say you want to kind of do both. You want to have some savings built up. What I see a lot of times is a good rule of thumb is 6 months worth of your expenses. So that way if job, medical, anything happens, emergency fund, something, you've got that to fall back on. Now, is that realistic for everybody to have that much in savings? Maybe not, but start somewhere. Start with 1 month, start with 3 months. Kind of build that as you're paying down the credit cards. You don't want to just have everything go into credit card debt, then something happens, you have to borrow back on the credit cards because medical or job loss or something happens. So you want to kind of balance both of them. Now, more towards debt, yes, because getting rid of the credit card debt will free up that monthly payment, the interest that you're paying that can go towards other debts or savings. But at the beginning of this, really start saying, okay, I've got X amount of dollars to work with. I'm going to put 80% towards debts. I'm going to put 20% of this extra money, 10%, whatever it is, towards savings. You want to balance those things out a little bit. And because I think it helps you build some interest income, it helps you build some savings, some safety nets. I think those are just as important as paying off all the credit cards. But I see too many people put all towards credit cards when, yes, most of it should. I'm not saying it's a 50-50 split. It should be 80%, 80-20 kind of thing, but don't forget the savings part of things. Make sure you're contributing to those accounts as well. Oh, if I receive a pre-approval from the bank for $150,000, but the house is worth $100,000, can I keep the extra 50? Good question. No. So a pre-approval is going to be based on the sales price of the home and is typically a loan to value that is a purchase. So you don't get cash back when you buy a house because it's going to go off the appraised value or the purchase price, whichever is less. So even if you're approved for more, if the house is only worth 100,000, then you're only going to get the loan for that difference. Now, if it's a cash out refi or it's a refinance and they can approve you for more, yes, you can keep the difference. But as soon as you fall into a cash out refi, anything more than $2,000, the rates and terms can change and usually jump up pretty significantly. So this doesn't say if it's a, when it says pre-approval from a bank, that is how much you can buy a house for. But if the house is less, they don't loan the full amount. They're kind of saying, okay, if you go find a house up to 150, you're approved. But if the house ends up being less than that, you don't get the difference. You're still approved for that particular sales price. And usually there's going to be some sort of down payment requirement on that 150,000. So it depends on how the pre-approval letter, if it's loan amount or sales price. So it depends on the pre-approval. But the short answer to this question, no. If you're pre-approved for 150,000, but the house is only 100,000, that's what they're going to loan, or they're going to use that number to determine how much they're actually going to loan to you. They're not going to loan more than what the house is worth. There was a time where they were starting to get more aggressive with that during the housing crisis. They were getting pretty aggressive at going above the home's value because of appreciation factors and willing to take on the risk that the home is not going to go down in value. But those days are long gone, and not anybody probably remembers about those days. But almost every single loan isn't going to go over. Very few even go to 100% anyway. So it's something where only a few really even go to 100% of the sales price, but nothing ever goes above, especially to give you the cash back. Because unfortunately, people would probably take advantage of that. They would run around and say, well, I'll go get this $150,000 loan on this $100,000 house. I'll keep the 50 grand. If I can't make the payment, I'll just walk away. I got no money into this. And I actually got money and I'm upside down and I can't sell the house because I owe more than what it's worth. People would walk away from that in droves. If they got 50 grand at closing, they'd just walk away from the house. Because why would you make a payment on a house that you owe 50 grand more than what it's worth, especially if you went to try to sell that home? So the short answer is no. It does not go above the sales price or appraised value, whichever is less. So in the same scenario, let's say it's worth 150,000, but they want 170,000 for the house. Well, the 20 grand you'd have to come up with on top of any down payment requirement. So they always go off the lesser of the two, the sales price or appraised value. That's what they're going to determine. Then your down payment is underneath that, whatever that number happens to be. So pretty good question. What should you look for when buying a house if you plan to own an EV? Well, I would say any kind of power station, a bank, the plug. If you have I think certain EVs have a different kind of outlet that you can plug in that can charge faster. So you want to make sure maybe the house has a 120 watt plug or something in there to be able to recharge the EV faster kind of thing. I think a lot of them will have like a way to be able to plug in just like a normal outlet, but I don't think they charge as fast or might hurt the battery versus having some sort of power station or some sort of outlet in the garage that does allow for maybe a recharging capability. I think a lot of new homes are kind of building those in, kind of like what you see on your dryer, where it has like a little different plug because it has a higher voltage that's going to that specific outlet. I think a lot of these EVs will have that function. And I think a lot of homes are starting to add that. Now, adding it afterwards isn't crazy hard, but it might be something you have to look into to be able to just run some sort of higher output type plug. And then some will even have like solar panels that will have batteries in the garage and stuff like that. So there's a lot of things that go into that, but I would say that's probably the most common thing. But almost every single house, even an old one, will still work with an EV. It's not like all of a sudden you can't own an EV if you own a home built in 1980 or something like that. So there might be some drawbacks on the power usage. You might have to have an electrician maybe look at maybe running a line for you that just can be a little bit more efficient for the car. Maybe doesn't take as long to charge up overnight, that type of thing, or doesn't hurt the battery if it's a slower type charging system. So I'd say that's probably the most common thing, but almost every house can be retrofitted for an EV or solar panels or those types of things. So, and they know that because they're not going to just create a bunch of cars you can't use practically. So as new homes are being built with some of these new features, just like Wi-Fi and just Bluetooth and signals and speakers built in. I mean, a lot of homes are amazing. The home builders are just amazing. The innovations they try to plug into. Same with cars. They're always trying to innovate the newest thing. And so a lot of homes will have a function where you can add kind of newer tech to the house. What are the most expensive hidden problems that typically get discovered after buying a house? So I would say the age of, if you don't get a home inspection, you do want it. I really recommend a home inspection. There's so many things they can catch on the age of the water heater, the age of the furnace or the AC units, that type of stuff. So I would say that's probably the biggest expense is some of the mechanical things that can go out, but they're usually pretty rare unless the home's a lot older. So the older the home gets, the more you want to check into those things. But I would say some of the hidden things are window coverings. Like people don't realize they've got to get blinds for all the windows. That's something like, oh, I didn't know that. Next is usually the utility bills go up. When you go from a rental home to an apartment or something like that to a house, usually you're going to have a bigger expense for the utilities. And you're going to have maybe a full water bill and a power bill and a gas bill. You're going to have more bills that maybe in an apartment complex that you wouldn't have. Maybe you didn't have gas at the apartment and now you have a gas bill. So there's going to be stuff like that that's going to be an increase to your utility expenses. And there's going to be just more of the maintenance. You got to mow a yard now that you didn't have to before. Maybe the roof needs to be looked at once in a while. The gutters need to be looked at. If there's any damage that happens in a storm or something like that, now you're a little more on the hook for that type of thing. But I would say the moving expenses, the window coverings, things like that become a little more expensive. Having to get cleaning supplies and just kind of stock your kitchen and your bathrooms. There's going to be expenses like, well, now that I've got this house, I want to have new plates and dishes, and that kind of, there's stuff like that. And some of that's the fun of getting into a house, is be able to get your own, new silverware, a new Tupperware, and new, just kind of new stuff like that. Maybe pots and pans you didn't have to have before. There's that kind of stuff. But I would say most people get scared when you start talking about the AC going out, or the furnace, or the water heater, or the garbage disposal, or the fridge, or the microwave, or the oven. There's a lot of things that are in there, but that's why a lot of times people will get what's called a home warranty when they purchase the house. And usually you can ask the seller to cover that for the first year, and then you can decide if you want to renew that every year. I'll tell you what, I've renewed my home warranty now, I think, for 4 years. They're amazingly effective, especially on a home I have is a little bit older. So I just say, I'm going to just renew this every year. And it even has a little chart on my dashboard at Elevate Home Networks that shows how much I've saved. And it's like thousands more, because I had a AC unit that went out, and that thing was like $5,000 or something like that. So it well paid for itself just with that one expense, and just anything else that could happen. My fridge, they repaired twice now. I think it's getting to the point where eventually it's just going to go out. It's like this big double fridge thing that my wife just absolutely loves, but it's pretty old. So they keep not wanting to totally replace it. So they just keep fixing it. So I'm like, okay, that's fine. That's why I got the warranty. So anyway, so I would say that's probably the most common things, but there's ways to address it with a home warranty. There's ways to address that kind of going into that can help offset some of the risk of some of those things breaking. But I tell you, home inspection on the front end is well worth it to negotiate if these things are aging out and have some issues that might require that warranty. What happens to your mortgage when you add someone to your house deed? Really nothing. If you're still on the deed, you can add anybody else to that property. It doesn't add them to the mortgage, doesn't add them to the debt, but it also doesn't absolve them from the debt, because the property is the collateral for the loan. So let's say in this scenario, you're a husband and just remarried, and you add your wife to the deed. It doesn't automatically add her to the mortgage. It's not like she just inherits the mortgage history, or now she has that mortgage debt she has to cover. The property still has to. So if something happens to the husband, it's not like the mortgage also goes with the husband, like he passes away or something like that. It's still tied to the house and the person. But you can add a trust, you can add a living will, you can add a spouse, you can add whatever to the deed of the home. So they're still an owner of the property, but doesn't really affect the mortgage unless that person is then removed. So you can't add who was originally on the loan, because that is basically like selling the property, or a due on sell clause, that the mortgage is kind of tied to both. But it doesn't absolve the person that did the loan if someone's added, and doesn't add them to the mortgage. So really not much happens with the mortgage when you add somebody to the property. Let's go to another category. Anybody ask any questions in the chat? You can jump in there as well. Let's jump into some more mortgage stuff. How are we doing on time? Oh, wow, we're like 43 minutes. Wow, having too much fun. What is the reason for lack of mortgage lenders willing to refinance a house with an FHA loan? Boy, I don't know if there's a lack of lenders that will do it, but there's only certain lenders that are FHA approved. So not everybody's approved to do FHA loans. Now, here's the interesting thing. A lot of people think that FHA loans the money. They really don't. They're the insurance company, essentially, that ensures that if you follow their guidelines and you do the loan, and then that loan goes bad, when you go into foreclosure and you take the property back, if there's any losses, that's where FHA kicks in. They can also handle the foreclosure proceedings as well by taking care of that loan through foreclosure, through HUD finance, or through HUD loans. and through just HUD handling the actual foreclosure itself. So the reason of lack of mortgage lenders, well, I don't think there's really a lack, other than there's some lenders that aren't FHA approved. But I don't think of any, almost every lender that I deal with is FHA approved. You're not going to have a hard time finding a lender that will refinance. And now, whether it fits FHA guidelines, whether you're better qualified for something else or you can't qualify for an FHA refinance, that's a whole other story. But when it comes to not willing to do it just because it's an FHA loan, you're talking to the wrong people. There's plenty of us that do FHA loans. How much loan amount can I get for a home renovation? Oh, that's a good question. So I'm seeing a lot of this where people have a great interest rate on their first mortgage, and to upgrade to another house, not only will they lose that interest rate, but they also have to jump up in the price. You'll see kind of a double whammy, interest rate and the price. The home they have only owe $300,000 on is probably worth $600,000. So replacing it, they have to jump to $600,000, and they got to jump to 6 or 7% on their interest rate. So a lot more people are looking into renovation, just making the home they want, adding bedrooms, remodeling the kitchen, adding a garage. I'm seeing a lot more people requesting home equity lines of credit for home renovation. So most renovation loans are going to go to about 90% of what the home is worth, minus the balance of any first mortgage. If you can get, the lower you can get that, the better the rates and terms. So say you only need 70% or 50%, the rates and terms are going to be worse because of how much you have to borrow. So how much can you get? Mostly you're going to be right up to about 90% of what it's worth. If you can keep it less than that, you're going to be better rates and terms. And it is after you count whatever you owe on the first. So if you already owe 90% of what the home's worth on the first mortgage, there's really no equity there. So I have a lot of people say, well, my house is worth $5 and I owe $450, so I have 50 grand in equity. I want a $50,000 loan. Doesn't really work that way, because they know that if you ever had to sell it, you're going to have price reductions, you're going to have commissions, you're going to have other things you have to pay for that come off the top. So you're not getting all the way up to 100% of what it's worth. You're going to be underneath that. Plus the market could change. So they want a little room. So most of the lines of credit are going to go about 90% of what it's worth to give that 10% cushion if they have to foreclose, if they have to sell the property. They want that little buffer in there. They don't want to go all the way up to 100% of what it's worth, especially on a refinance. Can I get a house with no interest, but on monthly payments? Can I get a house with no interest? No, unless you've got seller financing where you have a family member that's just willing to do that type of thing. But if you don't collect the interest on loans, or if you don't collect the money on it, you're going to just lose to inflation. So if I give you $100,000 today and you pay me back only $100,000 5 years from now, 10 years from now, 30 years from now, that $100,000 isn't going to be worth as much, just because of inflation naturally is going to eat into that. So interest rate factors that in. Plus, if I give you that money, I can't loan it out to anybody else. So now all of a sudden that money is tied up until you can pay off the loan. So no interest on a house isn't going to exist. That's where no interest on the house is renting the house, but you're not getting any value, you're not getting appreciation, you're getting tax benefits, you're not getting all those types of things, but you still have a monthly payment. So no, you can't get a house with no interest, especially when you're involved with somebody having to raise those funds, loan those funds, get a return on that investment, be able to just keep up with inflation. I mean, that's what interest rates are about. They're a risk offset. So let's say you don't make your payment, then they have to take the property back. There's expenses and fees with taking the property back. I mean, so yeah, there's got to be some sort of cost on the money. And then, so yeah, the answer is no. How can I refinance my home loan for better interest rates? So one, it has to be better interest rates available. So if you have an interest rate that's 4%, you're not going to refinance to a better interest rate. They just don't exist yet. Interest rates are higher than that. Now, if you're at 7.5%, rates have dropped to 6.5%, that's when you can start looking at these refinances. And it's very similar to when you purchase the home. It's a little bit easier in some ways because now you already own the home. There's not as many moving parts with agents and home inspections and things like that, but there's still home appraisal, income verification, asset verification. There's just a different little tier of purchase money mortgages and refinance money mortgages that both have different guidelines, but a lot of them overlap. A lot of it will overlap and be very similar. So really, if rates are better, take a look at a refinance. And I would also say this on refinancing: if you're planning on keeping the home more than 3 years, refinancing makes a lot more sense. If you're only going to keep the home for 6 more months, a year, the cost to do the refi when you don't have time to enjoy that lower payment doesn't offset itself. Meaning that if you have to pay $5,000 to refinance and you only save $50 a month, you have to keep that loan that long just to break even. So, 100 months to break even. Now, usually we're able to break even a lot sooner than that. That's why refinances make sense. And we're usually trying to target under 3 years, under 2-year recoup, depending on where the money's going, paying off debts, home improvements. There's other factors on why people refinance. But if it's just purely rate to rate, you've really got to save enough to justify the cost of getting the loan. Even if it's rolled into the loan, even if it's not out of pocket, just part of your loan amount, you still want to be able to recoup the cost of that within a certain time frame. Is it possible to get a home loan without a plan approval? That might be pre-approval. Maybe they meant. Now, plan approval, if it's a construction loan, no. So you do have to have the plans, if it's literally plans here, but I'm guessing maybe pre-approval. Is it possible to get a home loan without a pre-approval? I mean, technically, yes, but you want to get pre-approved first to make sure you can actually get the home loan before you put the offer in and risk your earnest money in. I don't know any seller that's just going to take their home off the market if you haven't at least done that first step of getting pre-approved. But they could, the sellers can just be like, oh, I'll go ahead and accept your offer. It's a great offer. I'll go ahead and accept it. But I can't tell you how many times people do that. In 30 days from now, they can't get their loan and they've lost the opportunity to sell it to anybody else. They've lost all that time. I mean, that's when you get sellers and agents just incredibly frustrated. So really the first step, if you need a loan to buy a house, get that step done first. You'll be so much farther ahead of the game. Your offer will be better. You'll know what you can qualify for. You won't be out shopping for homes you don't qualify for. Start with pre-approval. Really, it's so important. We'll answer so many questions, get you in the best possible loan you can get with a little extra time. Start with pre-approval. And I'd love to help you with that. If you go to ryanbolton.com, you can hit the apply now button. You can contact me. We can set up a time to meet. All that stuff costs you nothing. Doesn't cost a thing to find out what you qualify for. And we can issue that letter so you can go to a seller with confidence, say, yep, I'm approved for this house. Here's my letter. I can close in 15 days. By getting that pre-approval done sooner, you can also speed up when you can close, which can make your offer stand out. If you're a seller and you got an offer that can close in 30 days and one that can close in 20 and it's the same price, which one are you going to go with? Well, obviously the one with the shorter time frame. So that's one of the ways to have your offer stand out, is being able to get all your ducks in a row so you can close a lot faster. What are the benefits of a woman home loan and how do you qualify? Really, we cannot discriminate based on gender. So there isn't a woman home loan. There isn't a male home loan. There isn't a African-American home loan. There's not an Indian home loan. So these are protected classes based on equal housing and fair credit and all those types of things. We don't have an actual loan that is only a benefit for a protected class like gender. So there isn't a woman's home loan. Now, there is some that are maybe underserved areas. Maybe there's first-time home buyers. There's classifications we can do that aren't in those protected classes. But when it comes to race, nationality, gender, age, any of those things, there isn't a loan specific for that. Other than on age, you do have a reverse mortgage. You have to be a certain age to qualify for that. And you have to be at least 18 to sign a contract. So there's a couple things with age, but there isn't, in this question, there isn't like a loan that women can get that men can't, or vice versa. Those are protected classes, and there isn't a loan that's specific for that. Let's see what we're doing on time. We'll try to go maybe one more hour. Well, not one more hour. We'll go to the hour mark here. Do cash out refinance rates change daily? Yes, they change with any other rates. So it's not like there's a specific pool of rates just for cash out refi. With cash out refi, there's a hit to the interest rate. So when you have the loan file, you're going to have hits for credit score, loan to value, debt ratio. You're going to have all these hits that are adjustments to the interest rate. So you have kind of a base interest rate, and it goes up or down, mostly up, based on those hits. And cash out refi is one of those hits to the interest rate. So it doesn't have its own specific interest rate. It's based on kind of the base rates of the day that always change daily, hourly. They're changing all the time. And the adjustments to cash out refi do have some changes once in a while. I remember there wasn't as big of a hit. There became a much bigger hit for cash out refis a few years back that just cost more to tap into all this equity, kind of slow down all this creation of money, all this refinance money was just flooding the market. So they actually had some hits to that to just kind of cap how much money was being pulled out through mortgages. I think it definitely led to inflationary numbers. When you had interest rates so low, one of the things that we're doing, the government spending was one thing, the creation of money was one thing, the government stimulus was definitely a major part of that. But you also just had a lot of free money out there and people were grabbing it in bucketfuls. SBA loans were everywhere. People were getting all these SBA loans. It's basically new money created that were tied to these loans. So the cash out refi kind of had this hit to help maybe slow that down a little bit, but it does change daily. So the answer is this daily, and the hit to cash out refis can adjust based on what they're seeing in the market. Good question. That's a good one. Here we go. Let's see if we maybe tag maybe 2 more here. Can someone take over my mortgage payments if I can't afford them anymore? It depends on the loan. There are some loans that are assumable, but most are not. So the question in many cases is no, they'd have to re-qualify for a new loan to replace the loan that you have. Now, there's ways to do that with co-signing. There's maybe some ways to be able to help with that. There's even foreclosure in lieu of, where you basically just turn the property over and avoid the foreclosure, but still affects your credit by having that late. So there is that option if you have it. But that's where renters, or maybe turning into a rental property, see if you can kind of cash flow that way instead, or see if somebody can help with the payments, or have somebody do a refinance that basically replaces that loan. But in many cases, the new loan is going to be a higher payment than the one you have currently. So working out some sort of way to get the payment caught up is probably the best way to go. How do different down payment amounts affect your monthly mortgage payment and total cost? So down payment is going to increase the amount you're putting towards principal, so you're borrowing less, so then you are going to have a lower house payment, and depending on the money down, can lower the mortgage insurance cost, maybe even lower the interest rate depending on what you're putting down. But I've seen a lot of times that putting extra money down versus taking that money for savings, paying off other debts, emergency fund, is a better use of that money than it is to put it all onto the mortgage. But it can lower it. So that, simply put, if you have a $250,000 house and you put $10,000 down versus $50,000 down, you're borrowing less. So then you will have a lower house payment. Even the interest rate's the same. You're still going to have a lower house payment because you're borrowing less. And if you get into different tiers, the mortgage insurance can drop. So the cost of the total payment can go down. But I think it's worth running the numbers and say, okay, is it better to put 20 grand towards the house and save 30 bucks a month? Or is it better to take the 20 grand and get rid of credit cards, car payments, other debts that add up to more than that per month? So there's a balance of where that money should go, depending on what you have to work with. So that's part of my job, is to sit down with the client and say, okay, here's kind of what you qualify for. Here's some of the ways we can increase your qualification by putting less money down on the house, but getting rid of other debts, getting rid of car loans or visas, or even refinancing. I had one client that had money that kind of could pay down the car, cut it in half, so it lowered the payment, which was better served than putting it all towards the house. So part of my job is kind of looking at these options, not just take, okay, you have this much money down, great, let's go and move forward. There's so many things we can do to make sure we're getting you a better loan, not just a better loan, but a better financial picture, a better way to make sure that you're able to qualify for the house that you want, that type of thing. So yes, putting more money down does help, but it might not be the best place to put the money. Can 3 people each get a homeowner's loan? That's an interesting term. I haven't heard homeowner's loan. So a mortgage or a home loan. Can 3 people each get a homeowner's loan and use it together on one house? Yes. It's all one loan. You're just all co-signing on the one loan. So you wouldn't get 3 separate loans for each person. That's not how it works, because the lien position on the mortgage is what you're curious about. So if you have 3 mortgages, each one's going to be a different lien position. They're not equal. So if you go into a foreclosure situation, the first gets paid first, the second gets paid second, the third gets paid third. So the further you're in that order, the more risky each loan ends up being, because they're behind the one that takes priority. So in this scenario, yes, 3 people can be on a loan. I had one that was 6 borrowers. We had 6 borrowers on one loan for one property just to get qualified. Bunch of kids. It was a crazy situation. So not very common. I would say most common is 2 to 3. I would say that's much more common. When you start getting 4 and 5, it's really, really pretty rare. But yes, 3 people, it's not uncommon to have 3 people sign on one loan to be able to get the property. So that's a good question. All right, let's see if we can squeeze in one more here, hit the hour mark. Excuse me. How does home financing work? How much time you got? That's what this channel is all about, is to talk about all this. You got to get more specific on the question. How does home financing work? Wow. It's a mortgage. It's a loan. You get qualified for a loan. You use that money to buy the house. Is it better to get a 30-year fixed mortgage and pay it off in 15 years, or a 15-year loan? So I think there's a couple things with this. The interest rate on the 15-year term is going to be better than the 30-year term, but it locks you in on that payment. You have to make that payment every single month. Where if you have a 30-year term, you have that payment fluctuation that you're able to back off if you need to. If something pops up, you're able to kind of have that flexibility. But because of that flexibility, a lot of people will just revert back to paying the minimum. So there is a discipline that comes into paying extra on a 30-year fixed. But I think you're better off to take the minimum payment, kind of set it where you need to, helps with qualification on other loans, helps with just debt management, all that type of stuff, to be able to have the payment set as low as possible, because the extra money should go to any other debt first. It should go to savings, other debts first, then start targeting the mortgage. I've had so many times where people target their best interest rate, the lowest term, their tax benefits, all on the mortgage, and yet they're paying 10% plus on other debts. It's like, pay that stuff off first, or they have very little savings. You want to build those things first along with paying off the mortgage. So I feel like if you're going to have a debt, the mortgage is the last one to pay. Everything else pay off first. So if you've got X amount of extra dollars, yes, round up your mortgage payment. It's great, because a 30-year fix, the first 5 years is almost all interest anyway. So rounding up a little bit, getting into a 20-year term can save you a ton of interest. So rounding up the payment a little bit, biweekly, great. But I wouldn't set that minimum payment at a 15-year, because you are forced to make that payment every single month, regardless of what happens with medical, or car breaks down and you have to come up with that expense, or something happens where you're seasonal with work, or there's so many things that can kind of affect your cash flow, that I think cash flow is king. So having the minimum nut to crack as low as possible, then you have the flexibility of taking the rest of your money and putting it wherever you need to. So I think there's a blend. Pay a little extra to the mortgage, absolutely, but get all the other debts, snowball it, get all the other debts paid off first, so you can free up that monthly payment to really accelerate the mortgage, or to accelerate retirement, have savings in the bank. I would rather have a $300,000 mortgage and $300,000 in the bank than 100% interest and no money in the bank. So I want to have kind of a blend of those things. I often use the analogy: you wouldn't take all your money, put it in one gold bar or one stock. Everybody talks about diversification. When we're talking about paying off mortgages, that goes out the window. It's like, well, wait a minute. I can use that money to do both. I can pay off debts, build savings, and pay down the house. So I'm a big believer in diversification. I'm a big believer in that. Let's see. Let's see if we can find one more. This is a really good section here. Let's see if we can find a couple more questions. Oh, I saw one here. Let's end with this one. What are the best mortgage options for self-employed people? Well, there's not a different loan for self-employed. They still have the same requirements. Most people that are self-employed write off all their income. They have a lot more expense opportunities. They have a lot of ways to be able to write off their car, the truck, even their house, certain things within the house, the home office, whatever it might be. So what you'll see is their taxable income is way less than what they're actually making. So they can't qualify for these loans. So either pay more in interest rate, or you're going to pay more in Uncle Sam. That's kind of how it works. But there is loan programs that don't require tax returns to get qualified. We can use bank statements. We can use profit and loss statements, 1098s. We can use these, or 1099s. We can use those kind of forms, but the rates and terms are going to be worse. So you either pay Uncle Sam or pay it an interest rate. And what I find a lot of times is taking the hit with Uncle Sam is kind of a one-time tax expense for that year, but taking the hit on the interest rate for the next 5 years can add up to be a lot more. So that's part of my job, is to sit down with people, especially this time of year, and review the tax returns. So if you are self-employed, let's take a look at your tax returns first before you file them. And I can tell you, okay, based on this tax return, this is how much you qualify for. If that's not enough, we go back to Uncle Sam, maybe not take the deductions, not take the expenses, and just maybe reclassify them, whatever it needs to do to be able to maybe owe a little more to Uncle Sam, but then you qualify for a home loan. And a lot of programs, the ones that get the best interest rates, require a 2-year tax return. So if you wrote everything off in 2023 and now 2024, you have to claim a lot more income, you may be waiting until you file the 2025 tax return. So that's where starting this stuff now and having it get reviewed before it's filed, just to set yourself up for a loan maybe in 2026 or 2027, down the road. Having some of this stuff can make a huge difference. I can't tell you how many times people come into my, excited about buying a house, their business is going great, and they just wrote everything off. They can't qualify because they're self-employed. So there's different, it's not even different guidelines. The guidelines are the same, but people take advantage of the tax benefits with self-employed, and that's usually when they can't get a home loan because of it. So if you are getting ready to file your 2024 tax return, let me take a review of it, or have a loan officer take a review of it and say, okay, based on this return, this is how much you would qualify for. If it's not enough, maybe go back to your CPA and say, okay, I'm getting a refund. Let's reduce the refund. Or I'm already owing money. Maybe if I have to claim 10 grand more, whatever it is, how much more am I going to owe to Uncle Sam? So you can make that decision on whether that makes sense for you. But I'm telling you what, you're going to pay more in taxes or more in interest rate. And I think sometimes taxes is better. Now, not always. Every situation is going to be different. I'm telling you, get those taxes reviewed before you file. Once they're filed, you're kind of stuck with them unless you do an amended return, and that only can raise red flags. I mean, it's just better not to have to do an amended return. So I hope you found this video useful. I hope you found these questions useful. I like to try to jump on here and do these. I really enjoy doing mortgages. If you need help with a home loan, if you need your tax returns reviewed, if you're a first-time home buyer, need help with your credit, anything that involves real estate, I want to help you with that. You can check out my website at ryanbolton.com. You can apply there on my website. I have a mobile app that's on the website. I have great mortgage calculators on my website, or you can just reach out to me. We can talk about your situation and see if we can get you into buying a home. I think there's going to be a wave of home buyers coming back to the market as interest rates have gotten a little bit better, and you don't want to be behind that curve too much. You want to be on top of it and be ready. If a house hits the market that fits your budget, jump on the house, because I think that's going to matter more than the temporary interest rates that we're seeing. So give me a call, check out my website, ryanbolton.com, and I really enjoy talking with you, talking about mortgages, and we'll see you on the next video.